Ever wondered how the government secretly controls your money? Well, today, we're going to pull back the curtain on one of the most powerful and fascinating tools in economics: open market operations. This isn't just some boring economic theory. It's the secret sauce that impacts your job, your savings, and even the price of your morning coffee. Understanding this will give you an incredible edge in comprehending how the financial world truly works, making you feel like a financial wizard. Let's dive into this captivating topic piece by piece so you can master it. Introduction. Open market operations. Imagine you are the captain of a very, very big ship. This ship is the economy of a whole country. As the captain, your job is to make sure the ship sails smoothly, not too fast, not too slow, and always in the right direction. You have many tools, and one of the most important is open market operations. This is a crucial concept in macroeconomics, the study of the economy as a whole, focusing on big picture things like national income, inflation, and unemployment. Open market operations, or OMOs for short, are when a country's central bank, like the Federal Reserve in the United States or the European Central Bank, buys or sells government securities in the open market. This might sound complicated, but it's simple when you break it down. Think of it like this. The central bank is buying or selling IOUs from the government. These IOUs are called government securities like bonds or treasury bills. The main goal of OMOs is to influence the money supply in the economy, and by extension, interest rates. Why is this important? Because the money supply and interest rates have a huge impact on how much people spend, how much businesses invest, and ultimately how healthy the economy is. Body. The history of central banking, and by extension, open market operations, is quite interesting. For a long time, central banks didn't always have such direct control over the money supply. They used other methods, but as economies grew and became more complex, there was a need for a more flexible and immediate tool. So the concept of buying and selling government securities to manage the money supply started to gain traction in the early 20th century, especially after the establishment of the Federal Reserve. In the United States in 1913, central banks began to regularly use open market operations. Initially, they were used more to ensure that banks had enough money to operate smoothly. However, over time, central banks realized the powerful impact these operations could have on the broader economy. Chronology of open market operations. Step 1. The central bank decides. First, the central bank decides whether it wants to increase or decrease the money supply. This decision is based on current economic conditions. If the economy is slowing down and unemployment is high, the central bank might want to inject more money into the economy to encourage spending and investment. If the economy is growing too fast and inflation is becoming a problem, the central bank might want to take money out of the economy to slow things down. Step 2. Buying or selling government securities. Once the central bank has made its decision, it goes into the open market. This isn't a physical place with people shouting bids. It's more like a network of financial institutions. If the central bank wants to increase the money supply, it will buy government securities from commercial banks. It pays for these securities by crediting the accounts of these commercial banks. This increases the amount of reserves these banks have. Conversely, if the central bank wants to decrease the money supply, it will sell government securities to commercial banks. The commercial banks pay for these securities by giving up some of their reserves to the central bank. This reduces the amount of reserves these banks have. Step 3. Impact on bank reserves. This is a crucial step. When the central bank buys securities, commercial banks have more reserves. Reserves are the money that banks hold, either in their vaults or at the central bank. When banks have more reserves, they have more money available to lend out to businesses and individuals. When the central bank sells securities, commercial banks have fewer reserves, meaning they have less money to lend. Step 4. Impact on the money supply and interest rates. When banks have more reserves, they are more willing to lend money. This increased supply of loanable funds drives down interest rates. Lower interest rates make it cheaper for businesses to borrow money for investments, and for individuals to borrow for things like homes and cars. This stimulates economic activity, meaning more spending, more jobs, and more growth. When banks have fewer reserves, they are less willing to lend. This reduced supply of loanable funds drives up interest rates. Higher interest rates make it more expensive to borrow money, which discourages spending and investment. This helps to slow down an overheating economy and combat inflation. This entire process is like a chain reaction. A small action by the central bank can have a ripple effect throughout the entire economy, influencing everything from the biggest corporations to your personal finances. It's a delicate balancing act. And central bankers spend a lot of time analyzing data to make the right decisions. Consider a real-world example during an economic recession. When businesses are struggling and people are losing jobs, the central bank might engage in what's called quantitative easing. This is essentially a very large-scale open market operation, where the central bank buys a massive amount of government, securities, and other assets. The goal is to flood the financial system with money drastically, lower interest rates, and encourage lending, an investment to kickstart the economy. On the other hand, if inflation is running high and prices are rising too quickly, the central bank might sell government securities, effectively pulling money out of the system and raising interest rates to cool down the economy. Conclusion. So what have we learned? Open market operations are a cornerstone of modern monetary policy. They allow central banks to subtly yet powerfully steer the economy. By buying and selling government securities, they directly influence the amount of money circulating in the economy, and consequently the cost of borrowing money. This affects all of us every single day. Understanding OMOs gives you a deeper insight into the forces that shape our economic landscape. It's not just about complex theories, it's about real-world impact. When you hear about interest rate changes or economic stimulus packages, you can now connect those dots back to these fundamental operations. You now possess valuable knowledge that many do not, a true advantage in understanding the world around you. Keep learning, keep exploring, and keep mastering these essential concepts to become truly financially literate. Important English vocabulary and Korean explanations. Open market operations, 공개시장운영, 중앙은행이 국채 등을 매매하여 통화량을 조절하는 정책, macroeconomics, 거시경제학 국가 전체 경제 현상을 연구하는 학문, 센트럴뱅크 중앙은행 한 국가의 통화 정책을 담당하는 은행, Federal Reserve 연방준비제도 미국의 중앙은행, European Central Bank, 유럽 중앙은행 유로존 국가들의 중앙은행, Government Securities, 정부 유가증권 정부가 발행한 채권 등 본 채권 정부나 기업이 자금 조달을 위해 발행하는 증서, Treasury Bills, 국고채 단기정부 유가증권, Money Supply, 통화량 경제 내에 유통되는 화폐의 총량, Interest Rates, 이자율 돈을 빌리거나 빌려줄 때 지불하거나 받는 비율, Inflation, 물가가 지속적으로 상승하는 현상, Unemployment, 실업률, 일할 의사와 능력이 있는 사람이 직업을 갖지 못한 비율, Commercial Banks, 상업은행, 일반적인 예금 및 대출 업무를 수행하는 은행, 리저브 준비금 은행이 예금 고객의 인출 요구에 대비해 보유하는 현금, Loanable Funds, 대출 가능 자금 대출 시장에서 대출될 수 있는 자금, Economic Activity, 경제활동 생산, 소비 투자 등 경제 주체들의 모든 활동, Recession 경기 침체 경제 활동이 전반적으로 위축되는 현상, Quantitative Easing, 양적 완화 중앙은행이 대규모로 자산을 매입하여 통화량을 늘리는 정책, Monetary Policy, 통화정책 중앙은행이 통화량을 조절하여 경제 안정을 추구하는 정책, Financial Institutions, 금융기관, 은행, 증권사 등 금융 서비스를 제공하는 기관, Economic Conditions, 경제 상황, 경제 전반의 현재 상태, Stimulate, 자극하다, 경제 활동을 촉진하다, Overheating Economy, 과열 경제가 너무 빠르게 성장하여 인플레이션 우려가 있는 상태, 크레딧 신용 나중에 갚을 것을 전제로 돈이나 물건을 빌리는 것, Ripple Effect 파급 효과, 어떤 사건이나 행동이 연쇄적으로 영향을 미치는 현상, Investment, 투자 미래의 수익을 기대하고 자본을 투입하는 것, Spending, 지출 돈을 사용하는 행위, Financial System, 금융 시스템, 금융기관, 시장, 상품 등으로 구성된 체계, Assets, 자산 개인이나 기업이 소유한 재산, Exchange Rate, 환율 한 나라의 통화가 다른 나라의 통화와 교환되는 비율, Fiscal Policy, 재정 정책, 정부가 세금과 지출을 통해 경제를 조절하는 정책, Deflation, 물가가 지속적으로 하락하는 현상, Economic Growth, 경제 성장 국가의 생산 활동이 증가하는 현상, Gross Domestic Product, GDP, 국내 총생산 한 국가에서 생산된 모든 재화와 서비스의 총가치, Balance of Payments, 국제수지 한 국가와 다른 국가들 간의 모든 경제 거래 기록. Consumer Price Index, CPI, 소비자 물가지수, 소비자가 구매하는 상품 및 서비스 가격 변동을 측정하는 지표. Economic Indicator, 경제 지표, 경제 상태를 판단하는 데 사용되는 통계치. Liquidity, 유동성, 자산을 현금으로 쉽게 전환할 수 있는 정도. Default, 채무 불이행, 빌린 돈을 갚지 못하는 상황. Financial Market, 금융시장, 금융상품이 거래되는 시장. Securities Market, 증권시장, 주식, 채권 등이 거래되는 시장. Yield, 수익률, 투자 대비 얻는 수익의 비율. Debt, 부채, 다른 사람에게 갚아야 할 돈. Credit Crunch, 신용 경색, 대출을 받기 어려워지는 상황. Quantitative Tightening, 양적 긴축, 중앙은행이 보유 자산을 매각하여 통화량을 줄이는 정책. Overnight Rate, 초당이 금리, 은행 간 하루짜리 대출 금리. Discount Rate, 재할인율, 중앙은행이 상업은행에 돈을 빌려줄 때 적용되는 이자율. Reserve Requirements, 지급준비율, 상업은행이 예금의 일정 비율을 중앙은행에 예치해야 하는 비율. Stagflation, 스태그플레이션, 경기 침체와 인플레이션이 동시에 발생하는 현상. Financial Wizard, 금융 마법사, 금융 분야에 매우 능숙한 사람.